up, everybody? Philip Batchelder, realtor, here with you. Sell with me, Philip B is the channel. Sell with me, philipb.com. Check me on any of my platforms. Like and subscribe. Mash the noti button so that you are notified on what's going on in our current market today. And today's topic is what banks are not telling you. For example, banks are not telling you in order to grow your credit. See, people don't really realize that credit is looked at in certain ways, and there's a thing called a debt to income ratio that lenders really look at, and really 50% is the cutoff. So for example, let's say you go to buy a house, it's at 50%. Let's say your income is 5,000, but all of your bills going out are 2,500. Well, your debts are 2,500 and your income's 5,000. So that's 50%. So that gives you an example. And one way to really get your credit raised that banks are not telling you about is keep your credit cards. Credit cards can be a good thing, but they can also be a bad thing for most people because the average family in America has $33,000 in credit card debt. And if that's you, later on in the video, we have a solution for you. The Philip Batchelder Realtor team, Sell with me, Philip B. We have helped people do this all the time and still get them into the houses. And most of the time, people can wind up debt free. But one thing that they're not telling you is that there's endless ways. There's endless ways, guys, to buy a home. What do you mean, Philip? Endless ways? Well, it really just kind of depends on what the seller wants. I've had people that I know, I kid you not, guys. I have people that I know that bought a house for a boat. Would you ever sell your house for a boat? Maybe not you. Just depends on the boat for me, I guess. We're talking Michael Jordan's boat. I'm in. I'll take it. Another thing banks aren't telling you now is that medical bills do not count against your credit. Medical bills do not count against your credit. They're not considered in your debt to income. That happened in 2025. Bill was passed. They did it. Done deal. Good to know. Because that was a huge hindrance for most people. They would have these large credit card bills not credit card, but medical bills that they just can't pay. If you don't have insurance and something bad happens, they stick you with like hundreds of thousands of dollars worth of debt, which is ridiculous. And that's a whole nother problem in the economy is the medical system, but I can get my doctor friends on here to tell you all about that. So really, honestly, guys, I have lenders that are getting people approved, and here are some of the scores that you need. For VA, my clients are getting approved with a 580 credit score. A 580, guys, on VA. And usually with VA, you only need like $1,000 down, and then everything else is covered. Let's say you've been wounded to a certain percentage, they've declared you a medical discharge, then they actually cover all your closing costs as well in your VA loan. And if you didn't know that, and you want to know more about that, I am your guy. FHA is a 600 credit score. FHA is a 600 credit score. USDA is a 620 credit score. So it's not about credit right now, it's really not. Even Jerome, the guy in charge of interest rates, came out the other day and said people are stuck in their houses. I've said this quite a bit, is that people feel stuck. Most people can't even afford the home that they live in right now. Guys, let's talk about this whole approved thing. Either way, Nashville is a wonderful place to live, but there is no such thing as a pre-approval, okay? And quite frankly, if somebody has a pre-approval letter and they bring me a pre-approval letter on one of my listings, that's kind of goes against you, really, because if you're just pre-approved, that means that you did a very little bit of work. The lender said, hey, what's your income? What do you owe? This, that, and the other. Okay, quick credit run, boom. And you're now approved, or pre-approved, I should say. An actual approval, they will gather information from you, okay? They will collect bank statements and run your credit and do all kinds of things that need to be done to make sure that you're actually approved. So get pre-approval out of your head and just go ahead and tell the lender that I refer you to, or whoever refers you to, I want to be fully approved. So when I make an offer, they know that I am approved fully and that this thing is getting to the table, because right now you've got to have every edge out there. Another tip that they're not telling you, Close at the end of the month. Close at the end of the month. Why is that? Well, if you close at the end of the month, then you won't have a payment for 60 days. Why is that? Well, because they want to get you on their amortization schedule. You see, and if you close at the end of the month, that doesn't work because now the next month is already messed up. So they skip the payment when you close, the next payment, then you would have another payment. Okay, it would be 60 days out, which is phenomenal for you guys. And it's just a tip that you need to know. It's like, don't close on the 15th, just move it 10 days. Homes are a forced savings account, okay? And I absolutely love that idea. I actually had an investor friend of mine share that idea with me recently because, okay, I have 13 rental properties that are assets because they are savings accounts on top of bringing in monthly money. So the home you live in is a savings account as well. And like I said, in 2022, rates doubled, home values still went up, everything went up, and then everybody just all of a sudden felt trapped. Guys, one of the tips that I want to give you guys on paying your house off faster, this ties into the whole idea of no debt. I don't like debt, guys. There is good debt. I mean, listen, if you have a 4% interest rate on your house, you can make 10% over here. Then what does the 4% interest rate matter? If you found another way to make more over here, they offset. You see, this one wins, okay? So maybe this rental didn't make that much money, but this one made more, so they offset. I was even, or even I was above. I always come out in the black. Gotta come out in the black, guys. But if you'll make an extra payment, one extra payment a year, guys, that turns a 30-year note into 22 years. I set mine up bi-weekly, which means that I'm making 2.5 extra payments a year. So essentially I have mine set up to where it's a 15-year note, but I did it that way because I got a really good interest rate still on that, and I'm able to just pay bi-weekly. So, and I pay an extra $100 a payment bi-weekly, and bi-weekly payments are like turning your 30-year note into a 15-year note, but it also gives you the advantage of not having to do the bi-weekly payments and just paying that one low amount. If you are somebody who is ready to go, you're approved, you got this stuff, there's another type of loan. It is a 15-year. And that may be very fitting for you because a 15-year, lenders are discounting the rates. So let's say rates are at 7, they'll probably give you a 5.8 on a 15-year. Think about it, 15 years. 5 years goes by like that. Who agrees? Like below, comment, please. Talk to me here, people. 15 years, just like that, gone. And now your house is paid off. After 5 years, you've paid off 1/3 of that property, guys. That's huge. Do not do adjustable rate mortgages. They're still out there, and people think, oh, I got a 4% right now. Well, wait 2 years and then you'll have a 9 or a 10 or a 12, and then you'll be leaving your house. So please stay away from adjustable rates. Stay with those primary ways of buying a house. And the primary ways, guys, of buying a house are, you can go VA, FHA, USDA, you could pay cash, you could do a conventional loan. There's hard money out there. There's owner financing. There's crazy people out there that buy houses or sell their houses for boats. My point is you need a realtor, somebody who can make sure they can work through the muck and the mire for you to find out what's most important to them, because it may not be money, guys. And I've actually found a lot of scenarios where it's not money. Somebody passes away and they've got to get back home, or they get a job promotion, which is money for them. But you know, when it comes to selling their house, they're willing to take less because they're making more over there. You can be debt-free by using your equity. I'll say that again. You can be debt-free by using your equity. And what do I mean by that, guys? Well, here's what I mean. Like I said, the average household has $33,000 in credit card debt. They've got car payments, they've got boat payments, they've got quad payments. Go on Facebook these days. People are just trying to get rid of stuff. The economy was definitely tanked and we're coming back strong, baby. Think of it this way, right? Let's say you got $33,000 in credit card debt. Let's say you have $400,000 in equity in your house, and the house you want to buy is $600,000, okay? If they're one of my lenders, at least, and this is what they should be doing, hopefully they're watching the video, but this is what they do 9 times out of 10 is, okay, your debt to income ratios don't match up, but you got $400,000 in equity in your house, because remember, when rates went up, values went up, okay? So what happens there is the person will take their house, put it on the market, and they'll pay off all of their debts, okay? Let's say you have $100,000 worth in debt, 30,000 credit card, boat, whatever, car, whatever. Well, that equity immediately then pays off that 100 grand. Now you're debt free. No monthly payments, no minimum payments, no nothing on that, right? How much did that just increase your ability to pay monthly? How much did that just give you monthly right there, back in your pocket? It eliminated your debt to income ratio, because now the only debt you have is your house. And then you're gonna move into your new house, you'll still have 20% down. We'll still get the seller to pay your closing costs, which will keep $20,000 in your pocket, and you'll have a nice savings account. Just did this for a wonderful young couple, beautiful family, needed to make a transition, and they did the exact thing. I mean, they paid off debts, they were able to get into their house with 20% down, which saved them PMI, which is like, I don't know, guys. Anyway, the PMI is primary mortgage insurance. And if you don't put down 20%, then you have to pay it. But here's another tip for you that nobody's telling you. Right now, if you're still paying PMI insurance, this is very important. Hear me say this. If you're still paying PMI insurance and you've been paying for a while now, you need to contact your bank and ask them to reappraise your house and the value of your house. Because if the value is high enough to create that 20% margin, they'll drop the PMI off of your payment. Did you hear me say that? Call your bank, make sure that you tell them, hey, I've owned my home for 4 years. I believe I've got 20% equity in it now. Let's get rid of this PMI. It happened to me on my last house. I paid it down to a certain point, whatever. As you're paying, it goes down. PMI then can go away. But guess who's not gonna call you? The bank. The main thing that you guys need to know here is subscribe, like, hit the noti bell, because there is more content, more information to come. I want you educated. I want you to know how to build your credit. I want to tell you what the banks won't tell you. And I want you to be in your next home as soon as possible. And hopefully I could be the guy to get you there. So sell with me, Philip B, and we'll catch you on the next one.